So welcome everyone. Mergers and acquisitions in the marketing agency space. Let's begin. In our space, which is the marketing agency services, M&A is often not a consideration for any small business or small agencies. And I mean small agencies typically in the range of less than 10 million in revenue. And the reason why it's not often considered is because, there's a variety of different agency owners and types. And because of their either lack of business background or lack of finance background, this is a very disturbing potential topic for them. It's an unknown territory. It's outside their comfort zone. But what doesn't help this disconnect is the media. The media highlights these type of large transactions. They sing the praises of IPO type acquisitions and deals that are really difficult to digest at a small business level. And so when we think of the small enterprise, when we think of the types of businesses that agencies, professional service agencies operate in, it's challenging. It's challenging to really bridge the gap between what we hear happens in deals in the market versus what we can achieve. And even if we're starting to explore it, we're deal watchers, becoming deal makers, it's still, again, a large gap that typically is hard to cross. And it doesn't help with these types of players. The top 200 agencies, 198 of them are roll-ups. And so WPP, of course, is an aggregate of over 2,000 agencies, and they're consistently, continuously still doing deals and divesting those interests. And then you have other agencies that are these holding companies that really take percentages and shares of these entities. And that just means these holding companies usually have high billions of dollars, usually excess of $5 billion in gross worldwide revenues. And it's an aggregate of all these separate entities. When you see these top players, when you talk to as many agencies as we talk to and done as many deals as we've done, you start to hear this pattern, which is those are scary deals that cause team members to quit because they don't want to be a part of a large company, but those are the ones that get the better valuations, better purchase prices. So you have this interesting thing in our environment where these larger agencies, these top holding companies who are executing programmatic M&A, and I'm going to focus on that today. Programmatic M&A means more than a deal a quarter is ideal. And you can do what WPP did, which was a deal a fortnight, every 2 weeks doing a deal. But ultimately what we're talking about is a systematic approach to doing those deals. And this has created this negative chasm of if we do a deal, if we merge with someone, or if we get acquired, we're going to lose people. They're not going to be happy with us. It's a very selfish move by the owners, and there's going to be all this fallout and consequences. Well, that's true in many cases of these large billion-dollar and holding companies, these agency holding companies. In smaller deals, which we're going to talk about, and really programmatic deals at that level, it doesn't have the same level of consequences. So let's talk quickly, though, about what's been systemized. So if we look at what's been systemized, the agency acquisition process, and kind of demystify this a bit. So if we're going to break it down, it's these typical segments, right? You're trying to find the ideal target agency, and you want to know what that is relative to you if you're an agency looking to do an acquisition of others, or if you're trying to acquire agencies and use agencies as an asset in other deals. And then you have to find them the right way, right? Really, what is the correct locations? Because these sellers don't just aggregate. And going the right way doesn't mean talking to brokers. And then really motivated sellers. These are all things in this list that these large companies have systemized. And the reality is we can systemize them too. And this is the bridge and gap I'd like us to take today. I'd like to make sure you leave today knowing that the ability to execute programmatic M&A at a small business agency level can be accomplished like the big guns, like the big players in our space. And you have to have all of these steps understood and run it all the way to closed deal, post-deal integrations. Now, you may ask yourself, well, all right, is the economic climate we're in going to impact this, right? You're talking about programmatic M&A, systematic M&A. It's obviously going to have some response to the market. Well, that's kind of the good news in an ethical perspective. And the good news is that if you look at where Yelp's survey was, they had 97,000 businesses closing due to COVID, and that's closed in their little markers on Yelp. And a good percentage of them, 60% of those closed businesses weren't going to reopen. And that's a wide variety of business types. And you would think, okay, well, that's not all agencies. Well, agencies service those small businesses too. So there is a ripple effect that's caused in economic disruption. And so when you look at just COVID, so we call it deals or transactions that are in COVID, or COVID deals, you have to take in this next factor. This next factor is tied to what's commonly labeled the silver tsunami. And even though it's not everyone with silver hair who's doing this, it's literally that almost 500,000 businesses cease to exist every year. And this is from, the SBA on their estimates. And that means over 1,924 businesses close every single day. You account that to the impact of COVID, and you're talking about a significant amount of businesses that are just going to shut down. And that's with clients that need to be serviced, contracts, vendors, relationships. There's things in those businesses that are available. And so oftentimes it's very ethical. It's impactful to the economy to do deals with these types of businesses to save jobs, saves various forms of industries. And it can lead to, even though this is a horrible experience for most, it can lead to positive outcomes and positive next steps. In our industry, in the agency industry specifically, the Drum did an interesting review where 70% of agencies found 2020 challenging. Well, as humans, we all found 2020 pretty challenging. That's fair to say. But on the positive side of this, that same survey also had these people looking at, 60% of them, that the forecasted revenues were going to bounce back, and that this was a blip. This was a black swan event that didn't massively disrupt business, sans the industries that are massively disrupted by, tourism, travel. And so when we look at that as a perspective of our agency, yes, there's agencies that have been impacted, but we've also had this huge infusion of direct-to-consumer e-commerce, disruption of retail, really things that challenge, from a digital transformation perspective, the opportunities that agencies can service. So digital agencies became a very hot item in this sector. And so many marketing agencies started to evaluate rather servicing those digital assets and digital agencies and competing with them. They just acquired them. So what's the good news? Well, the good news is if you act fast. So if you act fast in a slow economy, which is this thing that we've experienced after the growth expanding economy ended in February, you see greater returns. And returns are the arbitrage game, right? You acquire low, buy low, you sell high. And so you get something at a lower value and you realize a higher value over a period of time or after a period of time. And what's important to know is that confidence starts to recover. So you look at multiples and we look at transactions. And when we're evaluating transactions and multiples for deals, for mergers and acquisitions and for buying businesses, they usually go up after the dip. So confidence returns, and then people value their businesses and assets more. So this is a very interesting time. The time where the discussion around the value delivery system, how the business works, can be more productive. Now, there was some belief, right, that not a lot of deals were happening. But then we started, looking around, and you started seeing a lot of activity. And these are through traditional brokers or M&A advisory firms, where a lot of that data gets presented because they're marketing what they do and they're trying to attract more potential deals to them. And this is the deals that are known in the market. Then there's all these private unknown deals. And there's been a lot of activity. Our buddy, David C. Baker, we quoted for this discussion we're having today, was one of the surprise ones. He's known for agency valuations. He's known in the space of M&A agency advisory. And you can work directly with him. And has this experience where, he thought the world was really going to be disrupted. M&A was going to be disrupted for agencies. And his expectation that it was going to slow or come to a crawl. And actually, it was the inverse. This fear of these vulture type large entities picking up all these weak small ones wasn't really what we were seeing across the board. You were seeing a lot of win-win deals. And although there are the ones who are picking up the distressed assets, there's been this climate of the fastest way to increase value, 2 + 2 = 5, is through mergers, is through the shared synergies of these deals. And so again, what did this mean? Well, that showed in the responses to turbulent times that a lot of agencies were thinking strengthening and growing. This is the tier 1 response to turbulent times. And within this, you have all these ranges. And being in tier 1 means you're proactively, aggressively going against the grain in the market. So we had a downward clip. These people went aggressively and started doing growth via acquisitions. So what does this mean? Well, typically, when you're taking off in a plane, you want to have 2 active engines. Now, I've been told and corrected, because I said you couldn't fly with 1 engine. Of course, you can fly with 1 engine. But would you board a plane where the pilot was like, ladies and gentlemen, thank you for boarding this flight to Phoenix. I just want to let you know we only have 1 of our engines operating today. We can still fly. It's safe. Don't worry. How many of us would still remain on the plane? Well, that's the same way we evaluate businesses who don't have acquisitions as a functional arm within their company. It's, yes, you can board the plane. Yes, the plane can still fly, but 2 engines, organic growth and growth through acquisitions, are a stable, safe diversification and the norm. It's just not in the norm. It hasn't been trickled down to the small business, the enterprises. And so let's ask this question. Why? What's the biggest challenge when buying your first agency? Why is that other engine not really there? And this is a common question that leads to us saying, deals are easy. Deals are actually very easy. You pull in accountants, attorneys, and things get more complicated, but they're relatively easy. They're straightforward. What's terribly challenging is integrations. It's like dating. Getting married is the easy part, the honeymoon, and then marriage is the rest of it. So you have this time period after deals that is the substantial concern of many of the companies who are trying to get into M&A. And then when building out a systematic approach to M&A, programmatic M&A, this is another one of the big barriers that they have. So I'm going to reveal something. You're not allowed to see this, but you're going to see it. This is ours. So what we had to do when building out programmatic M&As, we had to systemize all those things I listed in the same way the big companies do it, right? The big WPPs, the billion-dollar companies. We had to figure out a standard operating procedure for each step within the deal process. And of course, we're not naive. We knew integrations was going to be a big part of that. So the first 30 days, 30 to 60 days, and then the 90 days. And within this, it built a framework of how to approach roll-ups, so companies that we were absorbing and acquiring and bringing into the company. And then we have a version of this, which is called transformation, which is for companies that are external. So, companies that become subsidiaries of ours. So the reason why I'm sharing this is because this is just the overview. So to do programmatic M&A, a lot of times we need standard operating procedures and systems that unpack all of this infrastructure. So if we know that integrations is one of the big reasons why people don't, one of the biggest challenges, they don't move forward with doing their first deal, fear of integrations, not so much the fear of the deal or the cost of the deal. Well, we've resolved that by saying what you need. You need to have a standard operating procedure of how you're going to integrate them. The next thing you have to have as a consideration is driving deal creation. And driving deal creation means that you have a specific economic spread of value creation. So that means you have organic revenue growth, a predictable mechanism for that. And then you have a return on capital. So when you are making earnings, that earnings is getting converted into something that creates a multiple. So that's why it's very helpful to think of geometric investments as acquisitions, right? Essentially, you're going to geometrically grow rather than incrementally grow. And then sustainable performance across all of this. Multiple years of this being executed and proven is an indicator of success. And again, we like to say there's a difference between risk and risky. Things that are risky is gambling. There's risk inherent in everything. And you never want to lower risk. What you want to do is understand risk. Risk is inherent in deals that have good upside. So when you evaluate the risk, manage risk. That means we have a thing that will address that risk. And it doesn't mean it's a risky decision. Now, I'll simplify this to the strategic rationale of M&A, right? We're either going to drive efficiency, increase top line revenue, or cross-selling between capabilities and functionalities, or we're going to transform the business, as I hinted about, traditional agencies that really haven't enhanced their digital arm. But we talk about these different types of strategic rationales, and they have to be unpacked. The decomposition of this strategic rationale needs to be shown in a framework. So I'm going to share with you another framework, and this framework's really critical because these are the segments you typically are evaluating in due diligence. And so there's building blocks, the foundations of the strategy behind doing programmatic M&A, and then you're going to have these enablers, these things that are critical. So with professional service companies, right, agencies, we're taking people, we're creating technology to support them, and then they're servicing accounts, they're servicing the clients. And most of agency services rest on human resources and technology. Then you have the operating model, the organization, the financial model, and then the business strategy. So these enablers are really critical, and you have to have vision into how you're going to approach those. And these have, again, the implications of post-deal integrations. Therefore, you're really forging a bigger, more competitive entity by taking these fragmented pieces and understanding how they fit into a whole. Now, let's quickly talk about the industry that we're in and the overview of the trends. Oh my goodness, the lines are blurred. The agencies we used to talk to and the agencies that were around in the 70s and 80s, they were compartmentalized, weren't they? They were ad agencies, they were PR agencies, they were very clearly staying in their lane. Well, in today's post-2020, post-COVID or current COVID world, and the disruption that we just experienced from all of this pandemic of technology and how critical it is to operations, it's really changed and blurred the lines between these entities. And so what's critical with this is you no longer can just segment by type. Segment by type is nearly impossible. And so there's this blurred line. Let's just get on that foundation. That's a trend. More and more agencies are looking very much the same. And even if they look different on the market, they look relatively the same on the back end. Then the volumes increased. Well, I talked about that silver tsunami, right? The baby boomers who are now potentially exiting the workforce. You have this overwhelming amount that will be entering retirement, be stepping away. And this has led to this is what my thesis is around. It's led to this increase in transaction because of higher motivations. You have more motivated sellers than you've ever had before. And so what we're seeing is we've seen records in Q3 and Q4, and these record quarters of deals really create a temperature and a tolerance for this type of discussion and creates an ecosystem for it. And then, of course, deals aren't just big deals. They're a blend, and they're a blend of acqui-hires and revenue-based buyouts, employee earnouts, employee buyouts, et cetera. So there's a blend. Now, if we know those are the trends and what's happening right now, let's quickly unpack the types that really we can decipher still, but they're blurred. And these are usually the ones that you're trying to list when you're building out a target. So if you're building out programmatic M&A, you might be saying, we're a brand engagement, B2B, and we want to add B2B demand gen. We want to add B2B experimental marketing. We want to add, marketing technology. We want to add some AI. We want to add digital and content. So you would then be able to create a core view of what we call your universe, where you're at and what you're trying to accumulate. And this is, again, how we're thinking about a strategic ideal target, that first step that was programmatic in the M&A process. Well, if you are a buyer, what are you typically looking for? Well, this is good if you're also selling. Buyers are typically looking for healthy margins and growth. And I'll get into a table of how this is calculated. And the 2020 rule, right? Very critical. And then track record of client success. And oftentimes this has to connect to time records, like time tracking, standard operating procedures that are able to predict the client success. And then are we increasing market share by doing this deal? Or are we doing consolidation within the market? Expansion into a new market. So say you want to enter a new, Canada, or you want to enter Europe through France or Italy or Spain. There's a lot of ways to expand into new markets with it. And then change also currencies, diversify risk, and diversify geography. And then bolstering functional capabilities. Plain and simple, We don't got that. Let's go get it. That's a pretty straightforward way of thinking about it. We don't have the capability. We want to add it to the business. Now, a lot of this data you can find online. So I'll give you some sources here, like business valuations. These are the ones that if you go to an accountant or you go to a company that offers business valuations, this is what they're going to do. This is what you're going to pay that fee for them to do. They're essentially going to look at industry multiples, which technically is something that is tracked by, this professor over at New York University, and it's updated every year. And then there's different distributions of that list. The industry multiple is typically for EBIT, so earnings before interest and taxes, and it's for sophisticated small to mid-sized enterprises and up. And that just essentially means more standard operating procedures, less owner involvement, bigger entities, typically over 10 million. And then these business listing sites. So you can find businesses. BizBuySell is a business listing site. They give the data, the insights of transactions that they've closed and track it. So you have these sources that are relative valuations, relative comparisons, relative valuations. And then the accountant will do, or the advisor will do a valuation on intrinsic, what the business is worth. So what is impacting these valuations? And say you want to understand your own. If you don't know the value of your entity right now, how the heck are you going to do deals? To be very clear, one of the best ways to understand M&A is to be approached from someone to buy you and have to go through that process. And that's oftentimes where people learn about unique deal structures and valuation methods. So let's talk about some of the things that impact or are included in our valuation models. So in small, unsophisticated mid-sized enterprises, so it's SMEs, small to mid-sized enterprises is a classification in the United States. We have this really clear SDE, seller discretionary earnings. And this is calculation of all of the financial benefit that the owner gets annually. So it's a combination of profit, the things that are generated, the earnings from the business itself, and then what does the owner get? And those are typically then calculated as add backs if the owner, no longer pays for the company car and the telephone through the company if they're leaving, or their salaries even can often be added back. So you have owner benefits, discretionary cash flow and distributions, recasting those earnings. That's very, very similar. The good news is very similar to EBIT, earnings before interest, taxes, depreciation, and amortization. And we say EBIT for agencies more commonly than EBITDA. EBITDA is typically a term for publicly traded companies or large. It's not really the mid-market level. It's because there's not a lot to depreciate in agencies and amortize, not usually, at least not enough that's consequential to the valuation or purchase price. So a lot of times you're looking at EBIT. So when I get into some of the next valuation structures, we're going to look at EBIT. And so here's some good frameworks. Here's some good frameworks of how to approach multiples. Well, we have this nice tier in the agency world where people say, I run a 7-figure agency, 8-figure agency. And then you get into the 20 million agency, the 50 million agency, the 100 million agency and up. There's all these basic milestones and thresholds of top line revenue. And those are usually correlated to some levels of system and infrastructure achievement. And so what's interesting here is if you look at revenue, it's usually a good predictor of the multiples that you'll see on SDE or profit. And then if it's over $1 million, EBITDA or EBIT. And so it's an indicator of, all right, this is our starting point typically within the fairness zone. The fairness zone is the range that you're comfortable and fair and as a buyer, and then the seller is comfortable and it's fair. And it's a pretty distinct range as long as it's still built on reality. And there's a good statement. So they say, what is the valuation method we're using? Well, the one that gives me the purchase price I want. There's so many ways to evaluate a business, to do valuations. And there's many methods to calculate it. Oftentimes, the thing that they're using to calculate it just ties to the purchase price they want. And that deals with some level of ignorance, potentially misinformation, or maybe just an inexperienced advisor who just isn't used to agency deals. And so looking at this table, when we look at kind of a ratio between revenue growth and net margins, which I talked about as what buyers are looking for, this is a good starting framework. Keep in mind, this isn't the best practices. This is a framework. This is a table. There's a lot of nuance when talking about commercial, financial, and legal due diligence that allows you to, understand and mitigate risk, and then come up with valuations that are reflective of strong EBIT and multiples. Another thing that's really important here, if you look at what a multiple is, so if it's a multiple on profit, EBIT, typically if there's no growth rate, the company is not really growing, but it's got high margins. So 30% margins. Well, if you put a multiple, which is you pay the company, the owner, for a multiple on the profit, it will take that length in years, the multiple length in years. So if it's a 3x multiple, it will take 3 years with no growth, with consistent margins to get that money back. And most all advisors would say you should be getting a multiple return on your investment. So we typically like to say our job is to give the seller what they want in a way that gives us a multiple return. And we say that very clearly as the expectations. If we can't uncover within the deal a way for us to get a multiple of return that is higher in probability, then we're probably not going to be able to do a deal with you. So again, this ratio is really helpful, takes you down that path and gets you where you need to go. But now if the growth rate's really high and the margin's really low, oftentimes these things are going to predict a faster rate of return on doing that deal. And then never mind the synergistic value that's received if it's an acquisition of two agencies that can maximize and optimize clients. So I'm going to preface this next statement with this. Higher multiples tied to historical performance. It's not SaaS, it's service-based businesses. It's how long you sustained this type of margin and revenue growth and what leads to higher multiples. And so when you get to the higher multiples, again, these correlations are usually to size and top line revenue, but not always. There's small agencies that are doing rev shares and different ways to get top line revenue higher. But most of our industry is covered by this general statement, which is 10 million in top line revenue, 2 million in EBIT. And that is really the strong foundation, typically 50 people, that you have an infrastructure, a system, multiple systems, standardized, that others can acquire and then replicate and repeat. Goal targets, we look at things like labor under 50% of revenue, overhead no more than 25, operating profit 25, similar to what we were showing you in net margin. And when those aren't the case, right, whenever those aren't the targets, it again adjusts purchase price and the multiples being used tied to EBIT. And this is how negotiation of the deal, and really it's education. We like to say as general rule, even though we do negotiate, we prefer to collaborate. It needs to be, especially with proprietary deals that you source without a broker or advisor involved, you typically want to be collaborative because you don't want seller's remorse, and as well as you don't want to take advantage of our ethics. Our ethics dictate this. We don't want to take advantage of anyone. So we try to educate them as much as possible into the decision they're making. And we even recommend that they get comparable sources, third-party sources to, vet the statements that we're teaching them throughout the process of valuation and evaluating their business. Now, some special cases that I recommended and referred to earlier were acqui-hires, where essentially you're just acquiring talent. Straightforward. It changes. You're doing a deal. You're often taking clients and some people, and that just might be a client transfer agreement with some commission on those deals that came in. And you're really just going after the people, and those people will be employed within the agency. It's not buying the business. You're really getting talent, getting people. And then there's this whole other classification I'm not going to touch on in length, which is bankruptcy and insolvency. There is a whole thing that if you're looking to do those types of deals, there's methods of buyouts that could be seen as acquisition costs and really go after these disparate functional assets that are being, sold and liquidated. Non-financial drivers that you need to have as consideration is the Goldilocks rule. This is a general good practice in business anyway. So it's, big client, no more than 20%. And then, not too small. All those small require a lot of administration and therefore a lot of potential decrease in margins, and then scarcity, owner involvement. Owner involvement's huge. in the agency world. A lot of agencies were created by brilliant bottlenecks, brilliant creative people. There's 3 types of them from our perspective in our surveys. It's 80% of our agency marketplace are creatives, marketers. If they're solo, fine. They often pair with business development. So 19% have a co-founder or themselves are focused on business development. And then they have a really client and value delivery somewhere else in a different department, not them. 1% from our research and our conversations with hundreds and hundreds of agencies and the deals that we've done are business savvy. And business savvy means you're dealing with a business person who started an agency. They aren't the primary marketer. Usually they're working above sales and delivery, and they're not involved in those pieces. And so that's a clear thing. There's a whole nother classification in the larger agencies where you're talking about working above the business, and they're no longer even a manager of the actual business operations. So owner involvement is really critical because there's risks tied to owners' personalities, what they prefer to do, what they like to do, how long they've been doing it alone. And so this can have a big impact on valuations. And oftentimes, this is seen as their baby, their company, one of their, few companies they've ever started, and it can really impact their perspective on valuations. And then solid succession plan. I talked about this in a podcast recently about agency M&A, where it's not just succession plan of the owners, it's also succession plan or standard operations around churn. So even if you have all the systems in the world and those systems are managed by people, if those people churn, you have a system to replace those people. Because churn of all types, clients and people, is a known reality. And therefore, if you built a business system that doesn't resolve those types of churn, there's risks. And these are things that can affect the valuation of the company because those are things that have to be resolved by the acquiring company. Some books and resources that highlight a lot of the stuff I've covered today. Again, it's everything that I said is separated in tons of knowledge. We apply our own practice in what we do. We are actively doing deals. We have 46 deals in our pipeline just as of today, and this is always changing in turnover. We have a head of M&A strategy who runs that process, and these are the things that we always recommend agency owners and others who are looking to do deals. It's important to educate yourself. It's going into a domain. Even if you've done a few deals before, it's still important to prime the pumps. You want to make sure you're constantly looking at what's current and what's impact. Like, for example, the Black Swan talks about these large economic events we've experienced. So just quickly, I want to get to this part that I've been talking for a while. I am Peter Lang, partner and CEO and an investor. Uhura is our platform agency company. And so this has been mercifully short, given the amount of time Tatiana and Shelby knows I can talk on this subject. And since 2009, we've been actively, running the agency side of the business. We also, went on sabbatical in 2018, took 8 months. So we know what it's like to get out of the business. We know what it's like to have it run independently. And when we decided to come back into the company, it's because we wanted to focus on programmatic M&A. And we learned something that was really important. Remember those enablers I was showing in that table? The enablers talked about technology. I'm not going to go back. The enablers showing technology. It's IT is critical, tied with human resources. And so we implemented Jira, a large technology infrastructure that enabled us to really systemize delivery. So then we could bolt on teams and resources more efficiently. So again, absolutely nobody cares about that stuff. They care about, the information that's in regards to their programmatic M&A. Another piece of this is I'm often, I'm known in the spaces of doing agency M&A, but I'm very much behind the scenes, and a lot of people have never heard of me. I'm very happy about that. We've done a few things directly with investors for a period of time. We have an acquisition outbound lead gen engine, which supports investors in a deal sourcing, and ultimately got interesting. The team launched that service in the agency, and we started getting agencies doing it. And at first, the team was like, "Are we allowed to do agencies? Or is this going to be a conflict of interest? Can we do?" And then we found that the agency owners are actually the better ones, the people who have a marketing background. Marketing is such a critical function in supporting programmatic M&A, right? You have to have an infrastructure that allows people to know who you are when approaching them, or else you'd constantly be repeating yourself and validating your intentions. So marketing was really critical. Mark here, who we have shown on the slide, did that program. He's an agency owner, and amazing amount of deal flow, and started really seeing that the activity was there for doing deals. So people usually could just have me go and do one-on-ones and help them implement these systems. I stopped doing that and focused on this and focused on our programmatic M&A. But I'm still happy to do it. The main things that people know me for are M&A deals, really in our agency space, the sales infrastructure and mentorship of how to do this organizationally. And so that means we had to solve something. I'm going to take you back to our origin story of programmatic M&A a bit and talk about what we were able to build and what got us to 2020 deal management level, meaning a massive amount of deals coming through the pipeline. And whether it's in private equity, whether it's in general sales, one of the hardest things to do is source deals. It's just general lead gen and sourcing opportunities. It's consistent. Well, in M&A, in programmatic M&A, where you consistently have deal flow coming in, it never stops. You're always entertaining opportunities. You're always exploring potential market opportunities, always looking at the next deal while processing your deals and integrating your other deals. Means you have to nail down deal sourcing. And deal sourcing took us a while. We had our lead gen team. They built our acquisition lead gen engine, and then they were running this for our own internal activity. It was so effective that we started evaluating whether or not it's something we can share with other agencies. And that's what led to us really feeling good about it. It was such a critical aspect that led to people's first deals, companies' first deals. Then they built the standard operating procedures to get effectively into their second deal. And it takes a while for them to kick off without having all those systems in place in the beginning. Even if you read all the books, you're trying to aggregate and organize this data. And so some of the recent deals that we were doing and have done were really things that were functional capabilities as well as within our core business. And so we started getting more aggressive. So hundreds and hundreds of agencies have now gone through our pipeline, and we get to be very selective about good fit deals. And so this is the other part that I want to make sure everyone's very aware of. If you aren't processing enough deal flow, the first deal you do will have too much weight in it. Too much weight. It will feel too important. You need to be able to say, I'm going to do deals with you or with someone else I'm doing deals. One deal, one integration is a pathway to destruction. You will not be successful, from my opinion, you will not be successful doing one deal, doing one integration. Why? Because it will be the first time you do it, even if you bring in an advisor, and it won't go the way you planned. And so what led to us really getting motivated about this was, can we help companies make strong moves? Can we create an ecosystem, an agency nexus, where agency owners who are small businesses, right? We're not talking the large mid-market 100 million companies, can do programmatic M&A, and where there is deal flow, it can be shared and dispersed and collaborated on. Well, this requires it to be a really small group and kind of a trustworthy group, because this is a confidential process that we've standardized. And so what we're asking people, especially through this discussion on programmatic M&A, is, are you ready to make strong moves? And I'll tell you right now, deal watchers are aplenty. Many want to do this and they just don't execute. They don't have someone who's helping them along the way. It's really prevalent, the amount of steps that companies don't take. So we ask yourself, are you ready to make strong moves? Are you ready to do geometric growth rather than just focus on organic growth? Are you wanting to acquire another marketing agency? And all the steps that you need to do, we felt that, and we had to build. We know what it looks like. We walked you through a lot of the information that gives you the perspective within our marketplace. And so it's great if you want to do it, but you're going to need support. So what we all agreed to do was open this up. And so all the steps you need to know, all the steps that the big companies do, we then started building and sharing our systems. So we've created a course infrastructure, a module infrastructure, that if you're on this, learning about this resonates. It's one of the best ways you can expand and grow your own agency. And it's one of the most impactful decisions you can make to couple with your organic growth. And even if you're already doing it, but you're not doing it systematically, you're doing it as a tire kicker who eventually falls on top of the perfect deal. We've created a course that walks through all of our standard operating procedures that build off of this framework. It's one that we know has worked with all these other investors and works for us and has worked for other agencies that have worked directly with us. So now we're just opening this up and democratizing it to this small agency nexus, we're calling it. Understanding how to go after new sales channels, new businesses, understand how it feeds into the agency core business. We're going to make sure people understand how the models and integration types impact the deals you're going to do. Platform, bolt-on, tuck-in, acqui-hire, and then integration. Again, I focus on it. So I give a snapshot of our 30, 60, 90 day. That is literally the overview of all those standard operating procedures we're going to give you in the program. It's really makes us uncomfortable to think that we're going to be so deeply connected, but over the conversations of the people who've already joined the course and who want to be a part of what we're building here, it's very empowering and it's exciting to see other agencies who've experienced the same things that we've experienced and can receive the positive benefit of it. And ultimately, the acquisition process, mastering it, right? Having that deal pipeline that enables you to manage the complexity of a large amount of conversations. Many of you are CEOs of your agencies, you have partners, and you may already feel like you don't have time to do something like this. So following a process enables you to understand and structure it within your, what we call master M&A schedule, and understand the implications and requirements. And what's also critical is we've had team members who now are part of our A team, our acquisition team. You know, we teach you how to build your A team. And it can be external partners, but also internal partners as you mature it. And a lot of our standard operating procedures, if not all of them, come from people who were doing the work. People who were running integrations, running with us through due diligences on multiple agencies. And what enables us to then standardize it is because, like anything, if you're going to hire someone to do a job, you got to give them a standard operating procedure to do that job and set expectations on it. So essentially, we just now are standardizing what we're delivering and now providing that through this course. Examples of the things that we do. Sourcing. Yes, we're giving away the sourcing. The thing that we actually monetized to create acquisition leads for investors, we're going to give the playbooks of how it's constructed, how you can build it. If the good thing is marketing agencies are so well equipped to do this, it's ridiculous. Yes, that means there's going to be saturation. Why? It's a small group who's invited into this. We have a limit and we're selective on it. Not everyone who applies will be able to join. And then we're going to get into, here's another example, what to say on the first call with the agency. What's the intention? What are you trying to do? All scripted out, all things from hundreds of conversations with agencies that successfully predict whether or not there's a deal opportunity and next steps. We're going to give the deep dives, the things that really help you get to the potential deal opportunity that exists and data that needs to be collected, the metrics and information, before starting preliminary due diligence. And preliminary due diligence, how are you going to encapsulate an M&A process so it doesn't look casual and the person you're approaching sees you as a respected investor acquirer who they need to come prepared to communicate what they do. And so understanding this preliminary due diligence request process and then how then it expands to the either letter of intent, which we give you as well as the confirmatory due diligence process, and then leads to the crafting of the purchase agreement. All of the standard operating procedures we needed to do to have our team implement our programmatic M&A system, worked in collaboration with attorneys, accountants, and experts. And ultimately, back to where I was before, a detailed integration playbook. If you don't have the integration playbook, now realize you may be missing some of these things that we have. We talk about getting the team together. We have a culture Bible and understanding that framework. You'll see the pieces we've created to make this process doable, and then you'll have what you need to replicate it. And that's what's really critical. So this course is going to, other than everything I covered, in summary, understand the why and how. The how is really important, and how to communicate to these motivated sellers, how to leverage strategic roll-ups for growth, so growth via acquisitions, how to value these agencies, really the blueprint of how M&A starts, all the way to why and how we're going to execute it programmatically. And I'm going to make sure you very much know this. You could leave this call today and go straight to We Are Barney. They're an agency, marketing agency broker firm. You could go to David C. Baker and you could go the traditional routes, but there's a reason why we go after proprietary deals. So we try not to buy agencies that are for sale. We try not to do deals with agencies that are actively seeking. 80% of businesses don't sell. Think about that. 80% of businesses never get their transaction. And that's even if they list on listing sites. So and work through advisors, work through brokers, because they don't want to sell to oil companies, manufacturing companies who want to pick them up. They're brilliant bottlenecks, these agency owners are, and they really have this picture of what the company needs to be and who's the strategic acquirer that's going to be the right fit. And these are things that we need to know. And then how to succession plan. If you aren't looking to acquire an agency, you want to learn all of this because you want to build a succession plan from the infrastructure through acquisition. So you're not trying to grow, you're trying to leave the company. The best way is to get someone who's already done it, who's already doing it, rather than training someone who's a fresh hire to do it for you. The person who's done it somewhere else typically doesn't want to do it again. So it's hard to hire that person. It's really challenging to hire that person organically. So it's oftentimes the best way to have a succession plan is to acquire a younger person who you can mentor for a small period of time, but they've proven they can run a smaller version of your business and therefore step in from a succession plan to ownership, CEO, executives, et cetera. And so it's one of the best ways to do it. All the other methods, if you ask people about succession planning, they usually don't have answers. So what we're going to make sure you have is a way to define and create a program M&A blueprint, leveraging ours and then customizing it for yourself. And it's very, very important, by the way, that if you need help with this, this is why we've created this course. Yes, you could figure all this stuff out. We've saved you the time in doing so. So we have these modules, this information. We have a small window. We're starting this. It closes Friday, actually, doesn't it, Tatiana? Closes Friday, and it starts next week. And this is a program that's going to encapsulate many weeks of live. This isn't like you're going to log in and watch videos of me and the team talking about things. It's going to be interactive. You can ask questions. We're going to support you. We want you to be very successful. We want to potentially share deals with you that we have. We're going to do deal analysis of the things we've evaluated and we've done. We want to hear what you're doing. We want to hear your outreach. We want to hear the deals that you're working on. And really, again, create an agency nexus of potential deal makers who can improve and get better at, really growing, scaling, and adding that other engine that they don't currently have. So